Hello, welcome everyone. In today's video, we're going to look at the difference between debt and equity. Knowing the difference between debt and equity is crucial when looking at a company's balance sheet, especially if you're an investor. Alright, let's get started. Let's say this scale represents a company. The left part of the scale represents the assets of the company. Assets are resources owned by the company that have a future economic value. On the right side, we have our finance side, which tells us how the company is financed, or how the assets are financed. This can happen through equity or debt. The left and right side are always in balance, and this represents the company's balance sheet. A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time. This means that the balance sheet is a snapshot of a company, and thus it may differ even a week later. Let's look at a very simplified example. This will be our balance sheet of our company called Style Home. We buy home furniture, which we then resell against a higher price. On our left side of the balance sheet, we will show our assets. In other words, what do we have in our company? Our fixed assets represent assets that will have a longer economic life than 1 year and cannot be easily converted into cash. These assets are purchased for long term. In our case, we own the company truck that picks up and delivers the furniture, and we own the building of our office. Our current assets are assets which can be sold, consumed, or converted into cash within 1 year. In our example, we see inventory and current debtors. And last, we have our cash or bank account. Now the right side of our balance sheet will tell us how our assets are financed. As we saw, this can happen via equity or debt. If we look at the equity portion, the funds contributed by the owners of the company is considered contributed capital. The equity portion also consists of retained earnings, which is the accumulated net income of the company. Now the debt is an obligation that requires repayment. For example, if we go to the bank to request a loan to finance our company, we will receive the funds and therefore we might be able to purchase another asset. However, this fund needs to be paid back to the bank. Therefore, it is a bank loan. We also have our current creditors, which need to be paid back within 1 year. This is the case if we purchase and receive a laptop, but we haven't paid for the laptop yet. Now let's look at some key facts. As we can see, equity is inside financing, whereas debt is outside financing. The return that the company pays for its financing also differs if the finance happens through debt or equity. In equity, the return that the company pays is dividend, whereas in debt, the return that the company pays is interest. The company will need to pay interest even if the company is not making a profit. Dividend, on the other hand, will only be paid out if the company is profitable. Another key difference is the repayable aspect. Now there are exceptions, for example a buyback, but equity is not deemed to be repayable during the company life. However, debt is repayable based on the terms and conditions of the finance agreement. This is what we saw with the purchase of the laptop and the bank loan. This repayable of debt will need to happen whether you're making a profit or not. A final difference is the fact that interest is considered an expense and thus will decrease your profit and therefore will decrease your taxable income. Dividend is considered a sharing of profit, so it will not decrease your profits and therefore will not decrease your taxable income. It will decrease your retained earnings and therefore will decrease your equity. And that's it. That's the difference between debt and equity. Thank you for watching, and remember to like and subscribe to this channel to learn more about finance. Thanks for watching.